Hey, I'm Adam Jusko from ProudMoney.com, and in this video we are going to look at how a car loan affects your credit score. Does it raise it? Does it lower it? How fast? How many points? All of those sort of things. But before we do that, I'm going to ask you to please subscribe to this YouTube channel if you have not already, and if you have already, I thank you for doing so. So if you are getting a car loan, what does it do to your credit score? Does it raise it? Does it lower it? Well, overall, the answer is it depends, just like anything else when we talk about credit scores. So depending on how long your credit history is, depending on how good your credit history is going to have an impact on what a new car loan does to it, both when you get the car loan and over the life of the car loan and when you pay that car loan off. However, there are some things that are fairly universal in terms of what happens to your credit score, and it's really only a matter of, how many points it's going to hurt you or help you in each of those things. So we're going to try and look at those things that are universal, and again, I'll probably bring up the point repeatedly that is going to be different depending on what your credit history is and what you're doing with other types of credit that you have at the same time as that car loan. So let's start with the car loan application, which is undoubtedly going to affect your credit score negatively. Now, how negatively is going to depend on your credit history. So when you go to apply for a new car loan, whether that is with a dealer or it is with some other outside financing company, they are going to do what is known as a hard pull on your credit, or a hard inquiry. You are requesting them to check your credit to give you a quote on a potential loan. So that is going to hurt your credit. If you have a longer credit history, especially if it's a good credit history, might not ding you more than 5 points off of your credit score. If your credit history is a lot shorter, you could be looking at 10 to 15 points. You could potentially even be looking at 15 to 20, but most people are probably going to be in that 5 to 10 range in terms of the hit they are going to take from that hard inquiry. Now, many people, when they're thinking about buying a new car, aren't thinking that they want to get just one quote from the dealer. They want to get the dealer, and maybe they want to get an outside loan company, whatever the case might be. They want to get multiple quotes to make sure that they get the best rate. And if you just listen to what I said, that might give you the idea that each one of those is going to be a hard inquiry, and that, if you did 2 or 3 or 4 quotes, then all of a sudden you're going to have, 10, 20, 30, 40 points coming off your credit score. Well, that is not the way that it works. If you do multiple applications to get quotes within a short period of time, they will all be counted as a single inquiry in almost all credit scoring models. Now, what that short period of time is will depend. In most cases, it is 30 days. So if you get all your quotes within a 30-day period, they'll all be treated as a single inquiry. Now, older versions of FICO models used a 14-day period. Newer versions actually use a 45-day period, but you should figure 30 days is probably the time that if you want to get that application process done and secure that loan and only get one inquiry on your credit report, that's when you want to get it done within 30 days. Also, whether it is that initial hard inquiry or it is after you've actually secured a loan, the hit to your credit score is going to happen fairly quickly. If you are tracking your score, though, there's a good chance you won't see it for a month, because oftentimes those things are not updated on a rolling basis. All right, so now you have the new car loan, you have the new car, and you're going to get another hit on your credit score. That is because you have a new loan, a new line on your credit report. You also have decreased the average age of your credit accounts. Obviously, a new account is newer than the older accounts, and when you put them all together and you average the age, it has now gone down. And you have new debt that you are carrying. So right there you have 3 possible pieces that are going to decrease your credit score. Now, the other hit you'll take with a new loan is in credit utilization. This one's a little harder to explain because many people know what credit utilization means when it comes to credit cards, but it's a little different in terms of how it's treated with auto loans. So credit utilization on the credit card side means how much do you have on your credit cards in relation to how much they have given you in available credit. So if you have $10,000 of available credit and you have $2,000 of purchases on those cards, you are using 20% of your available credit. That's a 20% credit utilization. Now, when you open a new car loan, obviously you would be at 100% utilization, right? If you got a new $10,000 car loan and you haven't paid any of it yet, well then obviously you're using all of it, and you would be at 100%. Well, that would look very bad on your credit score and it would really hurt you. So the way the credit scoring models work is they don't treat it the same as they would the credit card. So it's sort of like the auto loans are over here getting a little different treatment in terms of the credit utilization. So it is hurting you in terms of the fact that you have a new loan on the books, but the fact that you haven't paid any of it off yet is not necessarily giving you a huge ding to your score like it would if you suddenly got a new $10,000 credit card line and you spent all of it right up to $10,000. So there is going to be a hit in terms of the credit utilization, but it's not going to be the same as it would be with a credit card. Now, potentially balancing out those hits that I just talked about is the fact that if you have a new car loan and you haven't had a car loan before or some other type of installment loan like a mortgage, maybe you've only had credit cards, you could be having a change to your credit mix. You now have an installment loan where maybe you did not before. And within the credit scoring formulas, credit mix is part of the equation. It's not a huge part of the equation, but it is something that will help you. It's another way to show that you can handle different types of debt. You can handle revolving credit, but you can also handle making a monthly payment in order to, get yourself to a place of paying off an installment loan. Now, obviously, when you have a new loan, you haven't really shown that you can handle it yet, but over time, that will help you. So, overall, when you look at getting that new car loan, it is going to drop your score. Again, the shorter your credit history, the more it's going to drop your score. The longer, the less it's going to drop your score. So some people can get a new car loan and maybe only lose about 30, 35 points off of their credit score when that happens. Some people get a new car loan, they might lose 50, 75 points off of their credit score, depending on what their credit history is. So the good news is from here it is all upside as long as you make your payments on time. So each month you are going to get rewarded in your credit score for that on-time payment. You're going to get rewarded by the fact that you are lowering the balance on that car loan in relation to what the original loan amount was. You're going to get rewarded by the fact that the average age of your accounts is going to go up because you're aging that account with each month you hold it. And then finally, you're going to get rewarded in that credit mix piece because still you're going to have that installment loan in addition to any other revolving loans or other things that you may have. And as you are paying off that loan, you are not only showing that you have the credit mix, but you're showing that you can handle the credit mix. You're making your payments on both of the types of loans that you have. Now remember that all of this assumes that you're doing the right things with the other credit or loans that you have. So the car loan is not going to have that positive impact if you are doing negative things with credit cards or other loans that you might have. Everything counts, everything interacts with each other when it comes to your credit score. But if you're doing the right things there, then everything I just talked about should proceed as I said. Now, with all that said, you're probably wondering when you're going to make up for that initial hit that you took when you took out the new car loan. For most people, it's probably going to take 6 to 12 months before you are back to where you were. Again, like I said earlier, if you have a longer history, the hit's not going to be as hard and you're probably going to rebound quicker. So it could be 3 months and you might be right back to where you were again. For most people, you're probably more in that 6-month range. If your credit is a little thinner, you don't have as much credit or it's not as good, more like 12 months. Now, that is, how you kind of rebound, how long it takes to rebound from that hit. But the good news is when you are doing all those things right after you've rebounded, you are going to continue to get more and more of an increase from that car loan for all the reasons I just said. You're going to have the on-time payments, you're going to have the average age of your accounts going up as long as you're not opening new credit. You're going to have that balance going down in relation to the initial loan that you took out. You're going to have the credit mix in there. You're going to be showing that you can handle that credit mix, you can handle an installment loan, and you can handle revolving credit that you might have. So your credit score is going to continue to go up, and that car loan is really going to start paying itself off in your credit score once you get past that first year for most people. All right, so let's say you had that car loan, you went through the whole process, 36 months, 48 months, 60 months, whatever it might be, and you finally gotten to the point where you're going to pay off that car loan, and this should really rocket your credit score even higher, right? You're going to have completely paid off that loan. Well, actually, no. Usually when you pay off a car loan, your credit score is actually going to go down. How much it's going to go down, again, probably is going to vary depending on other things on your credit report, but you can probably expect you're going to lose at least 30 points, probably not a ton more than that, but you're going to lose some points. And most people, this leaves them scratching their head because it seems like a very twisted way to calculate your credit score, right? If you pay off a loan, that should be a good thing in most people's world, right? However, in the credit scoring world, again, the twisted credit scoring world, that actually is seen as a little bit of a bad thing. And the reason is it's not bad in the fact that you paid it off, but what's bad is that now you don't have an active installment loan that you are paying off every month. And so from the credit world's view, what that means is we now no longer know what you can handle in this particular moment. Now we know what you used to be able to handle, and that will be, a good thing for you. That will factor into your credit score still, but because we don't know exactly what is happening at this very moment with you in terms of your ability to pay off an installment loan or to make monthly payments on an installment loan, well then that is going to hurt you. So it's sort of like, what have you done for me lately? I want to know exactly how you are now versus how you just were. It's almost like the stock market in some ways. They don't necessarily want to know what happened, they want to know what's going to happen. And so that is a little bit why you take that hit to your credit score when you actually pay off your car loan. Now the good news is that that is going to rebound as well, because you do have all those good things that you've already done. And in fact, when you take that hit, you could really think of it as you're taking a little bit hit to all those extra points you got over the life of the car loan. So they're taking some of them away, but that car loan did a lot of good for you. And over time, considering other credit cards or other installment loans you might have, that score is going to rebound again. So it doesn't feel good when it goes down, but it's really not anything to get upset about. You should see a rebound. Again, probably within a 3 to 6 month period, you'll get all those points back. So if you're thinking about getting a car loan and you feel pretty confident that you are going to be able to make those monthly payments for whatever the term of that loan is, 36 months, 48 months, 60 months, whatever, you shouldn't worry about doing it because of the initial hit that you are going to take to your credit score, because it will rebound fairly quickly and it will take your credit score even higher over the long term. The only time that I would say that you probably should worry about taking out a new car loan is if you are thinking about getting a new mortgage within the next 3 to 6 months, because you don't want to have that big debt from a new car loan being so recent when someone is looking at you for a mortgage loan. Otherwise, that hit to your credit score is a temporary thing, nothing really to worry about. So that's it. Anything I didn't cover, anything that was confusing to you, put your questions in the comments section below and I will do my best to answer them, or maybe some other helpful commenters will do their best to answer them. Thanks for watching, and as always, please go to proudmoney.com where we do credit card reviews, we talk personal finance, we talk deals, and all sorts of other fun stuff too. Thanks for watching. Bye.